a BEC question over risk and risk management. Ninja MCQ for BEC has over 1,300 BEC questions and 26 written communications. In relation to the role of capital in mitigating financial risk, it has been strongly suggested that in the new regulatory environment, regulators treat capital, and our options are, as a necessary component of risk margin reserves that should be held to deal with black swan events. And a black swan event is a sudden event that has a huge impact that cannot be predicted. Or as being inadequate on prima facie basis, which means on its face, like at first glance, and require that regulators mandate significantly higher levels of capital that would be fixed in nature to convince investors that the institutions could absorb risk, or as being inadequate and thus causing regulators to need to monitor and regulate compensation packages so that the incentive structure does not distort the proper evaluation of risk and cause management to make appropriate contributions to capital, or as a shock absorber and allow firms to draw down capital during periods of market stress that could be expected to replenish or to be replenished when market conditions improve. Now, if you're listening on the podcast, I've already lost you because of all the long-winded verbiage of the question. So let's go back to the question. In relation to the role of capital in mitigating financial risk, it has been strongly suggested that in the new regulatory environment, regulators should treat capital, and the answer is, as a shock absorber and allow firms to draw down capital during periods of market stress that could be expected to be replenished when market conditions improve. What you need to remember here is, and you likely will not remember everything about risk and capital and regulations, but what you can remember from this question is that in mitigating financial risk, the regulators treat capital as a shock absorber. Okay, so imagine yourself running the steps of the Capitol building and your shoes have a shock absorber. And if you remember nothing else, regulators treat capital as a shock absorber. Now, of course, there are the relevant terms. Black swan event, we already covered that. Capital, if you're watching the video, you can hit pause and read the whole thing. But capital is a factor of production, and it's one of the three essential elements of obtaining or producing wealth. It's man-made investment, like tools, machinery, equipment, buildings, storage, transportation. It helps produce wealth. That's what capital does. Financial risk is the variation in a company's performance that can be accounted for due to the use of borrowed money or leverage. Financial risk. Reserves. Risk margin is a component of insurance reserves that is established in addition to best estimate reserves. And we have our text. If you're watching the video, you can hit pause. But again, capital is a shock absorber that helps to deflate bubbles before they burst.